Invoice financing is a powerful financial tool that helps businesses get paid early for outstanding customer invoices. Instead of waiting weeks or months for customers to pay, businesses can access immediate cash to keep operations running smoothly. This technique has become increasingly popular among growing companies that need working capital but don't want to take on traditional debt. Invoice financing is a financial solution that allows businesses to access immediate cash by using their outstanding customer invoices as collateral, rather than waiting for payment terms to expire. Essentially, a financing company gives businesses money upfront based on invoices that customers haven't paid yet. This means businesses don't have to wait 30, 60, or 90 days to receive payment. Instead, they can get most of that money right away and use it to cover expenses, pay employees, or invest in growth opportunities. Many businesses face a common cash flow challenge. Customers often take 30, 60, or even 90 days to pay their invoices. This is standard in many industries, especially when dealing with large corporate clients. However, during this waiting period, businesses still need to pay employees, suppliers, and cover operational costs like rent and utilities. This gap between delivering products or services and actually receiving payment can create serious financial strain, especially for small and growing businesses that don't have large cash reserves. The process is straightforward. First, businesses submit their outstanding invoices to a financing company. The lender then advances 70 to 90% of the invoice value immediately, providing instant working capital. When the invoice is due, the customer pays the financing company directly. Finally, once payment is received, the business gets the remaining balance minus the financing fees. This cycle can repeat with new invoices, creating a continuous source of working capital as the business grows. There are two main types of invoice financing. Invoice factoring involves selling invoices to the lender, who then takes over collection from customers. The financing company communicates directly with customers and handles all collection activities. Invoice discounting, on the other hand, allows businesses to use invoices as collateral for a loan while maintaining control over collecting from customers. The business keeps the customer relationship private and manages collections internally. The choice between these depends on whether a business wants to outsource collections or maintain direct customer relationships. Invoice financing offers several significant advantages. First, it provides immediate access to working capital without waiting for customer payments. Second, businesses can scale operations and take on larger orders without worrying about cash flow constraints. Third, it's often easier to get approved for invoice financing than traditional bank loans because approval is based on customer creditworthiness rather than the business's credit history. Finally, it helps maintain steady cash flow during periods of rapid growth when expenses are high, but payments are delayed. Invoice financing typically costs between 1% and 5% of the invoice value, depending on factors like payment terms and customer creditworthiness. An important consideration is that lenders evaluate customers' ability to pay, not just the business's credit. This means businesses with strong, reliable customers can often get better rates. While invoice financing is more expensive than traditional bank loans, it's faster to obtain and easier to qualify for, making it a valuable option when speed and accessibility matter more than cost. Invoice financing is ideal in several situations. It's perfect when experiencing rapid growth and needing cash to fulfill new orders or expand operations. It works best for businesses with creditworthy customers who have long payment terms, such as large corporations or government agencies. It's also valuable when businesses need to cover operational expenses while waiting for payments, preventing cash flow gaps from disrupting daily operations. Ultimately, invoice financing bridges the gap between delivering value to customers and actually getting paid, enabling businesses to grow without being constrained by delayed payments.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.